So now you know what accounting means, and you've learned the definition of accounting in the previous segment. Let's understand the elements of accounting. I remember learning terms and definitions in school. They used to get really boring. Let me try and make it interesting for you. So I'll narrate a story to you. This story is about a guy called Rohit. From his childhood, Rohit always wanted to have a business of his own. When he finished his graduation, he finally decided to fulfill his dreams. So Rohit was always a foodie, and he planned to start a sandwich store. He took a space on rent and thought of a nice innovative name and called his sandwich store Yummy Bites. Yummy Bites is Rohit's new business. Let's give this a better name, maybe an accounting term. So Yummy Bites is a business entity owned by Rohit. Now what is a business entity? Well, business entity is a specifically identifiable business. When I say specifically identifiable, I mean if someone hears the word Yummy Bites, one can relate this to a sandwich store owned by Rohit. Now Rohit has a business entity called Yummy Bites. What does he do next? He needs to buy these to set up Yummy Bites. A set of stove, grill and chimney, a computer for billing, chairs and tables for customers to sit, breads, sauces, vegetables and toppings. So tell me, what do you think he needs to spend on all of this? Well, it's simple. He needs money. He needs to put some money in his business. Let's give this money a fancy name. Let's call it capital. Now, what is capital? Capital is the amount invested by the owner in a business entity. So Rohit invested 1 lakh rupees in Yummy Bites, which is his business entity. Let's rephrase this whole sentence. Let's say Rohit has a business entity called Yummy Bites with a capital of 1 lakh rupees. So Rohit uses the money to buy these products. Let's break this list into 2 sets. Set 1 and set 2. We can have stove, grill and chimney and these items in set 1, and we can have food items in set 2. Now take a moment and try and find out differences between set 1 and set 2. What differences could you find out? Let me list down some differences for you. While set 1 appears to be expensive, set 2 does not appear to be expensive. While products of set 1 can be used for a long period of time, say more than a year, products of set 2 would probably last a week. Products of set 1 are not a part of the sandwich. Customers can't relate to these when they think of Yummy Bites. They can't feel it when they eat a sandwich. But products of set 2 go inside a sandwich. Customers can relate to these products when they think of Yummy Bites. They can feel it when they eat a sandwich. Products of set 1 are not bought very frequently, while products of set 2 are bought every other day. Let's give these sets a name. Let's call set 1 as assets and set 2 as goods. Now, what are assets? Let me give you some examples to make you understand what assets are. If you remember winning a medal for your school, your principal says, "Great job, you are an asset to the school." Or you would have heard, "Sachin Tendulkar was the greatest asset the Indian cricket team has ever had." So you, after having won a medal or Sachin having played well for the country, are useful resources. So asset in general means a useful resource. But is there a way to formally define an asset? Yes, there is. So an asset is a resource owned by a business entity that can be expressed in monetary terms, and it provides future economic benefits. Well, that's quite a long definition. Let's break this definition into 3 significant parts. The first part of the definition deals with resources owned by a business entity. Imagine when your dad bought a TV, the electronic shop owner would have given him a bill. The bill had your dad's name in it. What does that signify? Why was your dad's name on the bill? The name on the bill makes him the owner of the TV. He can do anything with the TV. He can install it in the house, watch news, cricket, movies, get it repaired if it crashes, and even sell it when he no more wants to use it. The second part mentions expressed in terms of money. So your dad paid 15,000 rupees to buy the TV. So the TV can be expressed in terms of money, which is the price paid to buy it, which is equal to 15,000 rupees. Well, the final part mentions the future economic benefits. The TV your dad bought was a source of entertainment in the house. You could watch sports, news, movies, weather reports, and a lot of other things. So it would provide some benefits in the future. Therefore, the TV is an asset for your father. From this, we learned that for a product to be called an asset, all these 3 checkboxes have to be ticked. Even if one checkbox is not ticked, it will not be an asset. Now let's go back to Rohit's story with this new information. Let's evaluate products of set 1 and see whether they tick all these checkboxes or not. Let's evaluate whether stove, grill and chimney are assets for Yummy Bites. Talking about the first checkbox. Now tell me, are they resources owned by business entity? Absolutely. They were bought in the name of Yummy Bites, so Yummy Bites own stove, grill and chimney. Moving to the second checkbox. Can they be expressed in terms of money? Absolutely. Rohit paid 3,000 rupees to buy them, so you can express them as products worth 3,000 rupees. Talking about the third checkbox. Do they give any future economic benefits? Obviously, they will help in making sandwiches which will earn Rohit and Yummy Bites a lot of money. So as we saw, stove, grill and chimney tick all these checkboxes and therefore they are assets. Now let's move ahead. Let's see whether computer is an asset for Yummy Bites or not. Well, it's so simple. We'll check these 3 checkboxes whether they were ticked or not. Talking about the first checkbox. Is it a resource owned by business entity? Yes, it is. Rohit bought it in the name of Yummy Bites, so Yummy Bites owns the computer. Can it be expressed in terms of money? Yes, it can be. Rohit paid 15,000 rupees to buy it, so it can certainly be expressed in terms of money. Does it give any future benefits? Obviously, it will help in billing all the customers who would come and enjoy sandwiches. So computer ticks all these checkboxes and therefore it is an asset. Similarly, furniture is an asset for Yummy Bites since it ticks all these checkboxes. Now let's take an example. Well, an example which is not in the list above. Remember the first thing Rohit did after he thought of starting Yummy Bites? He took a space on rent. Now why did he take a space on rent? Because buying a place would have gotten really expensive. So he decided to pay a monthly rent for this space. Let's evaluate whether space taken on rent is an asset. Let's skip the first attribute for now. We'll come back to it later. Moving to the second attribute, can you express it in terms of money? Yes, you can. Rohit pays 5,000 as monthly rent for this space, so you can say Rohit's spend on the rent is worth 5,000 rupees. So it can definitely be expressed in terms of money. What about future economic benefits? It does provide future economic benefits. It provides space for kitchen, computer, seating area, or you can say the space has the entire store in itself. Coming back to the first checkbox now. Does Rohit or Yummy Bites own the space? Well, no, he does not own the space. He's taken it on rent from the owner for which he pays a monthly rent. Therefore, it is not a resource owned by Yummy Bites, and therefore it is not an asset. We discussed set 1. But what about set 2? Now let's evaluate the products of set 2. If you see, breads, vegetables, sauces and toppings are resources owned by Yummy Bites. They can be expressed in terms of money. And moreover, since they'll be used in making sandwiches in the future, they definitely provide future economic benefits. So you see, all the check boxes are getting ticked. But why are the products of set 2 not assets? There is something peculiar about them, which is not the case with stove or computer or furniture. Well, what is the peculiar thing? Now remember the differences we figured out between set 1 and set 2? Let's discuss these two differences. So one of the differences we discussed was that products of set 1 are not a part of the sandwich. Customers can't relate to these when they think of Yummy Bites. They can't feel it when they eat a sandwich. But products of set 2 are a part of the sandwich because they go inside a sandwich. Customers can relate to these products when they think of Yummy Bites. And they can obviously feel it when they eat a sandwich. So what do I mean by this? I mean, when you imagine Yummy Bites, you think of breads, sauces, vegetables, toppings. But you never think of stove or furniture or computer. Moving to the next difference. The other difference we discussed was that products of set 1 are not bought very frequently, while products of set 2 are bought really frequently. Rohit would buy bread, sauces, toppings and vegetables frequently, while he would not buy stove or computer or furniture very frequently because it's simple, they last really long. Now let me summarize the two peculiar characteristics of products of set 2. Well, the first characteristic is that customers can relate to when they buy sandwiches. The second characteristic is that they are bought and sold very frequently. And such products which you can relate to when you talk about business entity and are bought and sold frequently are called goods. What is the formal definition of goods? Well, it's not very difficult. Goods are tangible products in which a business entity is dealing. I said dealing. What do you mean by dealing? If you want to buy a car, you go to a car dealer. If you want to buy a house, you go to a property dealer. A car dealer would probably sell, let's say, 5 cars a day. And a property dealer would sell a house every day. That's why they're called dealers, because they're buying and selling goods frequently. So dealing is nothing but buying and selling a product frequently. Let me ask you something. Now tell me, would a computer be an asset for HP or would it be goods for HP? Now if you see, computer is what you can relate to when you think of HP. And since they are bought and sold frequently by HP, computers are goods. Now think about a furniture store. Tell me, would furniture be asset for a furniture store or would it be goods? Furniture is what you can relate to when you think of a furniture store. And furniture is something that a furniture store buys and sells every day. So furniture are goods for a furniture store. Now we see that while computers and furniture are assets for Yummy Bites, they are goods for HP and furniture store. So what do we learn here? So we learn that to classify a product into assets or goods, one needs to know the nature of business a business entity is doing. An asset for a business entity might be goods for another, and vice versa. Do you know what is the term used for buying goods? Well, it's called purchases. When Rohit bought breads, sauces, vegetables, he would say he purchased these items. When the car dealer bought cars, he would say he purchased cars. Or when the property dealer bought houses, he would say he purchased houses. Now Rohit has a capital of 1 lakh rupees, which he has spent on assets and goods. Suddenly, there is inflation in the economy. Almost everything is getting expensive. So he realizes he might run short of money. So he decides to turn to his friends for help. He goes to his friends to borrow some money. His friends turned out to be really helpful, unlike most of mine. They lent him some money. Let's give this money borrowed for Yummy Bites a name. Or in fact, a fancy name. Let's call it liability. Liabilities are amounts a business entity has to pay in some future period. If you borrow money from your friend, it's a liability. And so is your dad's credit card bill. Now let's take a moment and recall what Rohit has been doing so far. Well, he invested capital in Yummy Bites, his business entity. He purchased assets and goods, borrowed some money which is called liability, and he's recording all of this in a big notebook. So what does he do next? Well, he hires a couple of employees, a chef and a guy who does billing and collects cash. The chef starts making sandwiches and the store is open for customers. Customers start coming in big numbers. Rohit is delighted. He's dancing in joy. They're ordering all types of exotic sandwiches. Grilled vegetable sandwich, juicy chicken sandwich, steamy fish sandwich. So now Rohit has started getting richer with the money he's getting and his sandwiches are gaining great popularity. Now tell me, what is this money received on selling sandwiches called? Well, it's called sales or a fancier name, revenue. Now what do you mean by revenue? Revenue is the amount earned by a business entity by selling its products or services. For Yummy Bites, revenue will be the total of the money received on selling sandwiches. For Reebok, revenue will be the amount received for selling sportswear. Similarly, for Pizza Hut, money received by selling pizzas will be revenue. Back to our story now. At the month end, Rohit gets a lot of bills, such as electricity, rent, telephone, internet, and so on. Now, what are these called? Well, we use a very simple term to explain them. The term is expenses. Now, what are expenses? Well, expenses are costs incurred by the business entity in the process of earning revenue. Yummy Bites had to spend on these products so that it could make the finest and the yummiest sandwiches. So they're all called expenses. Moving ahead, one day Rohit reaches his home. He meets his dad. His dad asked him, "Son, it's been a month. How's your business going? How much profit are you making? Or have you incurred a loss?" So Rohit took out this big notebook and started doing the math. The notebook has various entries in his register, such as purchase of stove, grill and chimney, refrigerator, vegetables, electricity bills, sale of sandwiches, and so on. So Rohit sees 32 such entries. Now let me ask you a question. What are these entries called? Let's give these entries a name. Let's call them transactions. Now, what are transactions? Well, transactions are events involving some value between two or more entities. Now, let's see whether purchase of stove is a transaction or not. Rohit purchased it for Yummy Bites from a stove seller for 3,000 rupees. Since it has a value and there are two entities involved, which is Yummy Bites and stove seller, it is a transaction. Now tell me, what about sale of sandwiches? Is it a transaction? Let's see. 3 customers bought cheese sandwiches from Yummy Bites for 50 rupees each. Well, there are definitely two entities involved, customer and Yummy Bites. And value? Yes, there is definite exchange of value. While customers paid money, they got sandwiches in return. Similarly, buying a refrigerator, paying electricity bills, salaries, borrowing money are all transactions. So some of these transactions got in money and some transactions took money out. So by adding the values of money coming in, which we learned as revenue, and subtracting the values of money going out, which we call expenses, Rohit finds out one single figure and tells his dad that he has made a profit of 2,000 in the first month. Well, what is profit? Profit is nothing but an excess of revenues over expenses. So when my revenue is 100 rupees and my expenses are 80 rupees, my profit is 20 rupees. But when my revenue is 100 rupees and my expenses are 120 rupees, my profit is minus 20. Minus 20, doesn't that sound really weird? Have you heard anyone say that he earned a profit of minus 20? I haven't heard anybody. One usually says, I lost 20 rupees or I had a loss of 20 rupees. In other words, losses are nothing but excess of expenses over revenue. Let me ask you another question. Have you ever been sent by your parents to a grocery shop without money to buy stuff? Well, I've been sent several times. So you go to the grocery store, buy stuff, and tell the shopkeeper you're from flat number 2, Tower D. The shopkeeper hands over the stuff to you and writes down the amount against your house number. Now tell me something, did he sell stuff for free? I so wish, but no. Your dad would go at the end of the month and pay him for all the pending bills. So just like how you buy groceries, Rohit purchased vegetables for the month without paying the vegetable seller. Why? Because the vegetable seller would be paid together by the end of the month. So what do you call the vegetable seller in the example we discussed? Well, he's called a creditor. Oh, that's a fancy name. What are creditors? Well, creditors are people or business entities whom you've bought goods from, but you haven't paid them yet. But this sounds familiar with something we've talked earlier, right? Do you remember we talked about liabilities? We learned liabilities as amounts that a business entity needs to pay in the future. Tell me, don't the creditors represent the same? Yes, they do, since business entity needs to pay them in the future. So, what is the relation between amounts to be paid to creditors and liabilities? Well, amount to be paid to creditors is a type of liability. Getting back to our story now. Tell me, what will the vegetable seller call Yummy Bites? Or what will the grocery guy call your dad? What is the relation between them? Grocery guy has to receive money from your dad and vegetable seller has to receive money from Yummy Bites. So your dad is a debtor for grocery guy and Yummy Bites is a debtor for the vegetable seller. Now what are debtors? Debtors are persons or business entities to whom goods have been sold out but money hasn't been received yet. So if you go to Yummy Bites, eat a sandwich and request to pay later, you will be a debtor for Yummy Bites. Tell me something, would debtors provide some benefits in the future? Think about it. Yes, they would. They'll pay Yummy Bites money in the future. Also, does Yummy Bites have the right to receive money from them? Totally. Yummy Bites has sold sandwiches to them and needs to get money back. Or I can say that Yummy Bites owns the right to receive money from debtors. And it goes without saying, the amounts can be expressed in terms of money. Now recall the 3 check boxes we talked about. Resources owned by a business entity, expressed in terms of money, and future economic benefits. Now tell me, does amounts to be received from debtors tick these check boxes? Yes, it does. So we can say that amounts to be received from debtors is a type of asset. Now what has happened is that Rohit has run short of vegetables. So he sends the chef to buy tomatoes, onions, lettuce and olives. The vegetable seller tells him that you can buy tomatoes and onions, but the stock of lettuce and olives is over. What did he just say? He said stock. But what is stock? Well, stock is a measure of goods at any point of time. Since lettuce and olives are goods for the vegetable seller, since he deals in them, and he ran short of them, so he said that the stock of these vegetables is over. So for Yummy Bites, stock is a measure of breads, sauces, toppings and vegetables at any point of time. Now tell me, would stock provide some future benefits to Yummy Bites? Think about it. Yes, of course. Breads, sauces, toppings and vegetables will become sandwiches in future, which will be sold to get money. Also tell me, does Yummy Bites own its stock? Yes, of course, it does own its stock. And stock can be expressed in terms of money to state the obvious. Now remember we talked about the assets and the 3 check boxes that need to be ticked? Does stock tick these check boxes? Yes, of course it does. So can we say that stock is a type of asset? Obviously. So stock is a type of asset. So what does Rohit do now? Since he's had a couple of hectic months and he's done well for himself, he goes for a well-deserved vacation. Let's have a quick recap of what we've learned in Rohit's story so far. Rohit started a sandwich business called Yummy Bites. Yummy Bites was his business entity, which is a specifically identifiable business. He put 1 lakh rupees in his business. This money is called capital invested in the business entity. Rohit used money to buy stove, grill and chimney, computer, furniture. What are these? These are assets. He bought breads, sauces, vegetables and toppings. Well, they are goods for Yummy Bites. The accounting term for buying goods is purchases. Rohit borrowed money from his friends. Such borrowings are called liabilities. Rohit started getting money for selling sandwiches, which is revenue for Yummy Bites. He spent on electricity, rent, telephone, internet, grocery. Such spends are called expenses. When Rohit's dad asked him how his business was doing, he looked at transactions in his books. He told his dad he made a profit of 2,000 rupees. Profit is an excess of revenues over expenses, and losses are excess of expenses over revenues. Rohit purchased vegetables for the month without paying the vegetable seller. So the vegetable seller is a creditor of Yummy Bites. So if you go to Yummy Bites, eat a sandwich and request to pay later, you will be a debtor for Yummy Bites. When the chef went to buy vegetables, the vegetable seller told him that the stock of lettuce and olives is over. So stock is a measure of goods at any point of time. So you see, Rohit's story was definitely enriching. It equipped us with a lot of accounting terms, which you'll use as you move ahead in the accounting journey. So now you go out, use these terms and impress the world. If you go for grocery shopping, ask if there's a stock of fresh vegetables or not. Or when you meet your dad's friend, ask him about his revenue or profits. Or if you lend money to your friend, don't call him your friend, call him your debtor.